Hello class, in this video lecture we are going to discuss the revenue cycle, or also known as the sales and collection cycle. We are going to cover the following items in this lecture. 1. The business functions and process flow in the sales and collection process. Next, the documents and record used in the business functions. And finally, the internal controls embedded in the sales process. The actual process flow may differ depending on the size of the company and, more importantly, on the nature and type of the business of an organization. For example, the process flow for a small trading company might differ for a large manufacturing entity and as well as for more specialized entities such as banks, energy company, or even hospitals and health management organizations. That is why, for us to have a frame of reference in our discussion, we will assume a medium to large manufacturing company that sells a single product. Again, even for these companies, the actual process flow may still vary in practice, but we can expect that they will have at least the following common business functions. 1. Processing customer orders. Next, granting credit to customers. Third, shipment of the goods to customers. Third, billing customers and recording sales. Next, processing and recording cash receipts from customers. Next, processing and recording sales returns and allowances. Another, we have writing off of bad debts. And finally, estimating bad debts. The first business function is processing customer orders. The personnel responsible for this business function is the sales or the sales department. The receipt of orders from customers will initiate the process. The orders from customers can be received from a variety of channels. Walk-in customers may order in-store. Customers may also order via call, or customers may also use the company's e-commerce platforms to place an order. Finally, institutional customers may employ more formal means to place an order to the company, for example, by sending a purchase order. Since there are numerous channels by which a company receives the order from its customers, the risk involved here is that incorrect or incomplete information may be put into the company system in processing these orders. That is why, to standardize the format and to ensure the completeness of information obtained from customers and about their orders, companies use a document called a sales order form to formally capture the information from the orders of the customers. The sales order form contains important information such as the customer information, the description, quantity, and price of their orders, and the terms such as discounts, freight and delivery arrangements, and payment terms. The next step is to grant the credit to the customer. The department responsible for this function is the credit department. The credit department serves an important control point in the revenue process since the sales or the sales department is incentivized to bring as much sales to the company since most sales personnel are compensated based on the volume of the sales. Thus, there is a risk that the sales would bring more customers even if some of those are not credit-worthy. The credit department typically reports to the finance or accounting department in a company. The finance or accounting department is responsible for managing the financial operations of the company, including credit and collections. By having the credit department report to the finance or accounting department, the company can ensure that credit policies are aligned with overall financial goals and objectives of the entity. The finance or accounting department can also provide oversight and support to the credit department, ensuring that credit decisions are made in a sound and responsible manner. Depending on the size and structure of the company, the credit department may also report directly to senior management or the CFO or Chief Financial Officer. Now, from the standpoint of good internal control, the credit department should approve first the credit of the customer before any shipment is made. Because once the inventory is shipped to the customer, the company departs an asset of value from their custody, and the risk of loss will arise in case the customer will not be able to pay for that order. That is why, when the customer places an order, the credit department must check whether the outstanding balance of the customer plus the value of the customer's new order are within the customer's authorized credit limit. In a computerized information system environment, this checking can be automated or embedded within the entity's system already. Thus, the system would either allow the transaction to proceed or reject based on this checking. In a manual system, the approval can be indicated in the sales order form. Therefore, the output of the credit granting function is an approved sales order. After the credit is approved, then the next step is to ship the goods to the customers. The shipping department is responsible for ensuring that products are shipped to customers accurately and on time. The shipping department typically starts by picking the products that have been ordered from the warehouse, verifying that they are the correct products, and confirming the quantities. Once the products have been picked, they are packed into the shipping containers, such as boxes, envelopes, or pallets. The packing process involves selecting the appropriate shipping container, securing the products inside the container, and labeling the container with the correct shipping information. A packing slip is a document that accompanies the shipment and lists the products that are included in the shipment. The packing slip also includes other important information, such as the customer's name and address, order number, and shipping method. After the products have been packed, they are ready for shipping. The shipping process involves arranging for the products to be transported to the customer using a delivery service such as a courier or postal service. A bill of lading is a legal document that serves as a contract between the shipper and the carrier. The bill of lading includes details such as the type and quantity of products being shipped, the names and addresses of the shipper and receiver, and the shipping method. The next step is to bill the customers and record sales. Billing the customers inform them of the amount due for the goods delivered, and it must be performed correctly and on a timely basis. The one in charge here is the billing department, which is normally under the finance or accounting function. Now, the most important aspects of billing are as follows. First, all shipments made by the company have been billed, which addresses the completeness assertion. Second, no shipment has been billed more than once, which addresses occurrence assertion. Because if a shipment is billed twice, then the duplicate transaction is already fictitious, since that sale did not actually occur anymore. And third and last one, each billing is for the proper amount, which addresses accuracy assertion. Upon billing, a sales invoice is prepared, which includes the information about the description and quantity of goods sold, the price, freight charges, payment, and other terms, and sent to the customer to inform them about the amount of the sale and the payment due date. Each sale is recorded in the sales journal or sales book, which accumulates the information about the sales transactions for a given period of time and is used to update the company's ledgers. Now, the sales journal is a type of special journal that enables a company to save time in recording repetitive transactions such as sales to customer. In a computerized system, preparing an invoice automatically generates an entry in the company sales journal and simultaneously posted to the relevant ledgers, which we will discuss next. The entries in the sales journal are used to update the AR or accounts receivable subsidiary ledger or subsidiary record. This record includes information about individual sales, cash receipts, and sales returns and allowances for each customer and to maintain customer account balances. This record is usually arranged per customer and shows the receivable opening balance, each sales transaction, cash receipts, returns and allowances, and the ending balance for each customer. This record is usually used by the billing department to manage customer relations. On the other hand, the accounts receivable control account or general ledger is a more aggregated type of record which shows the opening balance of the total receivables, the increases and decreases in the account, and the running balance after each transaction and at the end of each period. If the AR subsidiary ledger is more detailed and is used by the billing department to manage customer relations, the AR general ledger, on the other hand, is more aggregated and is used by the accounting or finance department for management and financial reporting purposes. And from the standpoint of good internal control, the sum of the individual balances from the AR subsidiary ledger should agree to the balance per general ledger at any point in time. When the AR subsidiary and general ledgers are not reconciled, it indicates serious weakness in the controls over the recording process of sales and cash receipts. One relevant report in managing the company's billing and collections is called an aged AR trial balance or aging of the receivables report. This report is prepared directly from the AR subsidiary record and shows the total balance of AR per customer or per invoice or both, as well as the breakdown of each balance in accordance to the number of days that the receivable has been outstanding, grouped by category of days such as less than 30 days, 31 to 60 days, and so on. This is also used by the company to evaluate the collectability of the receivables and to estimate the allowance for uncollectible accounts during the adjustment process. Finally, the last document that we will discuss in this business function is the monthly statement sent to the customers. This statement is sent by the company to each customer at the end of each period, usually a month, indicating the opening balance of their receivable, the amount and date of each sale, payments received, credit memos issued, and the ending balance due. It is in essence a copy of the customer's portion of the AR subsidiary record. This serves an important control mechanism over the billing and collection process, since in case there are discrepancies or inaccuracies in the process, the customer will normally complain when they receive an inaccurate statement from the company. The first four business functions are geared toward delivering the goods to the customers, correctly billing them, and reflecting the information in the accounting records. The remaining four will involve the collection and recording of cash, returns and allowances, write-off of uncollectible accounts, and providing for bad debts. The processing and recording of cash receipts includes receiving, depositing, and recording cash. Customers usually pay using cash, checks, or via electronic fund transfers, and this business function is handled by the cash receipts department. The most important concern in this process is the possibility of theft, and this can occur even before receipts are entered into the company's records. It is therefore important that all cash receipts are deposited intact in the bank at the proper amount and on a timely basis, and recorded in the cash receipts journal or book. Companies also use a variety of control over cash receipts process, such as physical protection, like use of cashbacks, and CCTV surveillance over the collection area. Segregation of duties, such as the person handling the cash does not have access over the accounting records of the company, and other controls like encouraging customers to deposit directly the payment to the company's bank accounts, acquiring insurance such as fidelity bond over the cashier, and mandatory vacation leaves for employees with cash handling functions. For smaller companies, control may involve close management or owner supervision. The entries in the cash receipts journal are also used to update the AR subsidiary and general ledger, but this time the movement is to decrease the balance of the receivable in the respective ledgers. The next business function is processing and recording sales returns and allowances. When the company sold a defective item or the customer is dissatisfied with the quality of the goods, the company often accepts the return of the goods or grants the customer a reduction in the charges. Upon receipt of the good, which is the responsibility of the receiving department, they prepare a receiving report for the returned items and returns them to the warehouse. Meanwhile, the billing department will issue a credit memo or a credit note to the customer. The format of the credit memo is similar to the sales invoice, but it supports for a reduction in the amount due from a customer instead. The issuance of a credit memo will generate an entry on the sales returns and allowances journal, which serves a similar function as the sales journal. That is why some companies record these transactions in the sales journal instead of maintaining a separate journal altogether. Now, the entries in the sales return and allowances journal will be posted to the accounts receivable subsidiary and general ledger as well. But the effect is to decrease the balance of the AR, similar to cash collection. That is why controls should be in place in recording returns and allowances, since embezzlement in cash collection can be concealed by recording a fictitious returns or allowances. Regardless of the diligence of the billing and collections or credit departments, some customers will not be able to pay their balance when due. In case this happens, reasonable efforts should be exerted by the company to recover the amounts. However, if it is shown that the customer won't be able to pay their due even after sending demand letters, or if the customers became insolvent or bankrupt, the company may decide to write off the receivables. This function is often done by the accounting or finance department, but proper authorization must first be secured from the appropriate officer of the company, such as the treasurer or the CFO. Since this transaction will involve a credit to receivables, then it may also be an avenue to conceal a cash shortage arising from embezzlement, similar to the discussion of sales returns earlier. The write-off will be recorded in the general journal, and it will be posted to the allowance for bad debts and accounts receivable ledgers, decreasing their balances. Finally, accounting standards require companies to estimate bad debts on their receivables and recognize an allowance to be deducted from the balance of receivables when they prepare and report financial statements. This is done by the accounting department with instructions from the management based on the company's accounting policies, which should be aligned with the applicable financial reporting framework and applied consistently from period to period. The recording of allowance for bad debts and bad debts expense is done on the general journal and may be performed by the company typically on a monthly or quarterly basis. And that's it for the business functions in the sales and collection process, including the related documents and records. Just to summarize our discussion, remember that the sales and collection cycle involves the decisions and processes to transfer the ownership of goods and services to customers after they are made available for sale. It began with a request by a customer and ended with the conversion of the goods into an accounts receivable and ultimately to cash. Thank you for watching this lecture, and I shall see you in our next lesson.